Okay, so let's go ahead and chip in what we have today for the session. Okay, sorry, yesterday we missed yesterday class. Yesterday was actually we supposed to be having this class, but unfortunately, I've not been too active with my health to be able to come online. So I said today I have to come online so we won't forget the 2 classes we already had. We'll be continuing the class today and tomorrow. We can be able to cover everything we need to cover this December in preparation for next year. A recap for class we have had and what we are supposed to have, or what we are supposed to have known. Everybody understands what the basics of market structure is and how it can get fucked, right? I believe we understand that. I believe everybody understands retail and smart money concepts and how it can get fucked over using the MSU. And I believe everybody understands what an order block is and how it can be referred to as buy to sell and sell to buy. And also the sponsor candle, right? Everybody understands demand and supply as to the entire buy to sell, sell to buy, which is the market in itself. Then every other thing within that marketplace is the store in the marketplace where you can pretty much transact in the marketplace. Yeah, this recap I just give. Anybody has any question before we proceed? Okay, so today we'll be looking at this guy, which we already know by now. Too powerful and control many things we know. So it's the external and internal structure. It is this point that we understand structure. We are going to talk about everything together. So just follow me. You will have everything. We all know generally in Forex, looking at the market, like, before we even start trading, we do our top-down analysis, right? Yeah, if you want to know that, if there are any better trader you have ever known, or any best trader, or any real profitable trader you ever know, you understand that, yes, they are, before they do any analysis, they are meant to do what? Top-down analysis. So when we are doing this top-down analysis, and we go to monthly time frame, like this, let me check. So we say this is our, we are doing top-down analysis and we are starting from a monthly time frame. Let's say this is a monthly time frame. And this monthly time frame you are seeing here, weekly is internal to this monthly time frame. Let's say we have weekly here, internal to this monthly time frame. So we can say, monthly. What is internal to monthly is weekly. Weekly is the internal structure to monthly. Monthly is external. What is internal to monthly is weekly. Then we say what is internal to weekly is daily. And what is internal to daily is H4. What is internal to H4 is H1. What is internal to H1 is what? M15 or M5. So we said H1, what is internal to H1 is M15 or M5. When it comes to intraday trading, When it comes to the understanding of the algo itself, because the best thing to do with understanding the algo is go with the time frame that keeps you closer to the understanding. And when it comes to H1, I pay attention to 2 time frames. Let me see, when it comes to intraday trading, I pay attention to majorly 2 time frames. The first one is M15 and M5. The best time frame for intraday trading is M5. However, you can trade the M5 time frame without understanding the M15 and H1. Let me come again. However, you can't trade the M5 time frame without understanding the M15 and the H1. You need to understand it because this time frame depend on each other. We said our H1 is the external, then internal is M5 and M15, both time frame. So we have our M15, which is internal to, which is external, then the internal time frame is our M5. Yeah. And just as I said, our intraday trading, the best time frame for our intraday trading is M5. And so we still have our M15, internal to M15 or M5 is H1, is M1, sorry, M1. Yeah. So what is internal to M15 and M5 is our M1. That's about 1 minute. So we said, remember we said M5 is your best time frame for intraday trading, but you can't jump and start trading without understanding M15 and H1. This also means that if you have seen what you are looking for on this M5, you have to go to the internal time frame. Not compulsory though, but which means if you are using your M5 as your primary time frame, when you see what you are looking for on M5, you can go to an internal time frame. Not always compulsory, but you can do that. And your internal time frame is the M1 time frame. Yeah, take note, one of the key parts of trading is this intraday trading. Why I show intraday trading because it is one of the concept that is closer to how the market behaves. Everything I can show you here, you can interpret it in swing trading, scalping, and even in long-term trading. But I want you to understand how the market itself works. So that's why we're using this time frame that are so much closer to the market, to the way the market behaves in any instrument at all. So however, sometimes what you are looking for, you might not be seeing it in one time frame, like 5 minutes, but you can see it on 15 minutes. And you just go to M1 and pick your trade. So that's why you have to combine this time frame together. That's why M1 is internal to both of these guys. M1 is internal to both of these guys. Yeah. What I'm looking for, if I see it on the H1, I won't jump to my M1 to pick the trade. Rather, I will go lower to my M15 or M5 to see better before I jump to my M1 time frame. The purpose of this is to understand the liquidity cycle. So this is the liquidity time cycle. We are in time frames and the liquidity cycle is this year, time frame structural analysis. And that is where we are currently. That is what I'm paraphrasing about. Which we'll get to time to liquidity cycle, but we need all this concept in conjunction to be able to reach liquidity cycle. But what I've been explaining currently to you is time frame structure analysis. If we say this is our monthly, let me use something different here. We are having higher high, higher lows, higher highs, higher lows. Okay, these are higher highs, higher lows. Okay, then inside this internal, you still have another one here. Another trend inside here. Another internal, which means another time frame is internal to this internal structure. So if this is a monthly, which is the black line, and we say the weekly is the red line, and it is internal to it, and this is we say daily is the blue, which is internal to the weekly also. So this is what you were taught about internal and external structure. True or false? How well? If you look at this concept I just showed you now, this is what we are being taught. This is what you were taught when starting up in Forex. This is about internal structure. Yeah. So if you look at this, you need to look deep and ask yourself, how well has this helped you in your trading? Okay, let's leave this aside, one side. Then, if you look at this, what if you have this? And you have low, high, low, high, low, high. Let me come again here. High, low, high, low, high, low, high. Break of structure here. What is that? High, low, break. Inducement here. What was that? What is this? Low, high, low, high, low. What is this again? Fuck. Came down. So look at these two now. If we say this is A and this is B, if you look at this B, it's annoying, right? The way the B is trading, the way the B is moving, it's annoying. So let's call this one A and let's call this B. In between A and B, which is prevailing in the market? Definitely. Both of them are still external structure. It is still, they still have internal structure. But you can tell which of this is subjective and which of it is objective. But you see, a lot of people will not understand which is objective and which is subjective. What they do is they go ahead, begin to force this B to look like this A. because this is the actual way the market moves. This is how the market is actually configured to work. But because of our knowledge and the small thinking, this is how we represent it. But we still go ahead with like the way a lot of people do, because they don't understand what is objective and what is subjective, or what is objective. They tend to go ahead and force this B to look like this guy. So they try to do something like this. Oh my God. They can say this is a low, this is a high, 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 this is a high, this is a low. What have they successfully done? Then, at the end of the day, they have successfully made this subjective once more. They have successfully made this subjective once more. You can see how subjective it is. This and this are not the same. They are not the same because they have successfully made this subjective. This is why the first step toward understanding objective structure is by recognizing every single transaction that takes place in the market. I say what? What did I say? I said this is the first step toward understanding objective structure. So for us to be able to trade properly, it is required to be recognizing every single transaction that takes place in the market. You must recognize that there was a transaction here. There was a transaction here. And there was a transaction here. And there was a transaction here. And there was a transaction here. 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 Here and here. A lot of people will want to ignore this transaction here. So if you have something like this, a high, a low, a high here, a low, a high, a low, a high. Someone will mark it, a lot of people will mark it like this: high, low, high, low, high, low, then high. A lot of people want to ignore this and draw their structure like this. No, you don't do that. If you have higher high in this area, high and low, if you do this, stop doing it and you ignore this. Stop doing it. Don't do that. You intentionally ignored this transaction that took place here because you said it is not significant. Okay, let me ask you, what is significant and what is not significant? Tell me how much is significant. How much do you consider significant? If you consider a $1 billion to be significant, then if you have $100 million, is that not significant too? Is $10 million not significant? So who told you that this is not significant? What if the amount traded here that causes this small push here was $100 million? And you ignored it and mark here as your high, your low, your high, your low, and mark here your high, ignoring this. So every single push in the market is a transaction that needs to be paid attention to. So when you are paying attention to this transaction, when you now have your edge comparing this transaction to the previous high and lows, that has been created. Okay, the previous major highs transaction to the previous highs and lows that was being created, which is like your internal highs or your external, and internal with the previous internal highs with the previous internal lows. Then you can know how to use this effectively. Everything here is being significant. However, relative to this high and low, this one here, this price has been internal to this one. This price is internal to this one. Yeah. But it does not mean I'm going to ignore this. I'm going to ignore this because they are internal to it. Now I can tell for sure that this is also important. If price come up here, if price come up here and come down here, I'm going to buy this sheet or buy this sheet to the upside. Hope you all can see my screen, right?
Yes.
Okay, that's good. So everything on this chart is what? Significant. And you have to start looking at structure from an objective view. So you see, by the time you start looking at structure from an objective view, you begin to realize that all that is happening along is not necessarily I won't say manipulation. See, let me tell you one thing, one truth today. It's the hard truth, but the market is not interested in manipulating you. The market is not interested in manipulating you. The algo of the market is just behaving in a certain way. In a certain way. So it is not interested in manipulating you. The algo of the market is behaving in a certain way that whoever understands it will earn it. Okay? But for us to understand it, we are the one taming it as the market is manipulating it. You can have a trade here. You can have a trade here and the market comes there and drop. If it was interested in manipulating you, you will be taken out. But sometimes you can have your trade here. And the market comes and take it out and drops. So you see, it's just delivering as it is so desired. Your own is to understand what makes it tick and how it does its deliveries. That is how it delivers. Two main things that makes it tick. Number one is liquidity. Number two is efficient pricing. I believe we still understand efficient pricing, which we covered. So it was our last class, efficient pricing. So number one, liquidity. Number two is efficient pricing. Hope you are getting me. If you understand, everybody. And it is not the market fault. It is not the algo fault that makes it deliver that way. It is our fault. It is only delivering based on our emotion and application to it. If majority of people start looking at a new level to pick their trade, you will see. For instance, someone asked me, do you think the algo will change? My answer to the person was like, the algo has already changed. In fact, the algo is always changing. The way the market moves is always changing. But you know something, what you are has already become the algo. So you won't even realize that you have changed. Because you can always tell where the liquidity is. When market comes around here, it comes here, you know, it comes here, you already know where to buy from. You can buy here. It comes here, you can sell here. You know you are selling here. Buying here, selling here. So tell me how the market is changing that you can't realize. So you're already here to sell again, because you understand the liquidity has been taken. So there, you are now going here, and you can buy here too. So one thing that will never change about the algo is the liquidity. Even if every smart money trader, retail trader, or every single trader change their trading style, one thing for sure is, as they are changing their trading style, you know for sure where the liquidity is. Now you know for sure, you realize in a minute what you are exposed to in your learning phase. So why will price break a structure? This is BOS. This is the one. This is BOS, right? Get. So why will price take break of structure and continue lower? Was it that everybody saw this as a break of structure? Everybody tries to sell. So this is a break of structure. Everybody tries to sell and grab liquidity and drop. So if everybody tries to see here, sell, and it grabs liquidity and it drops. So whatever way you look the market here, it doesn't still stop the market from doing what it wants to do. But actually what is happening here is what everybody is seeing as breakout structure here is what we call fake BOS. This is fake BOS, and this is inducement. Then continuation. Then you have your continuation to the downside. Oh. Oh, sorry, I'm supposed to put it. This is our, if this is a down trend, then you have your inducement here. This is your inducement, fake BOS. We have our fake BOS, our inducement. Then continuation. So whatever way you label this, it doesn't still stop the market from doing what the normal lower lows and lower highs. But where is the edge? This is the edge. When it wants to go higher, you get fake BOS, inducement. It goes to take the break of structure, inducement. That is how it works. But you don't know what fake BOS has been all the time or previously. All you have in your arsenal is confusion. But now you understand this is your trading. This is the way you have to be looking at your trading. And so your trading can be more easier this way. Even in areas that is even in area that is not efficient. Let me say, even in areas that is efficient, and price drops, and you can't seek fake BOS in that area, you know that in lower time frame, where you have MSU there, price is going to drop. If this price didn't get efficient and it dropped from that side, check lower time frame. There is going to be an MSU in this area. Okay, that is why price literally dropped from where you are not expecting it to drop. Okay. So remember I said every transaction in the market will not happen if liquidity is not provided. Just like you are going to the market store. Any item that needs to be sold from the store, money has to be provided. Even giveaway is still paid for from someone. This is like a short-term downtrend. But what is happening on this trend? You are having what we call fake BOS inducement. We have fake BOS inducement. We are having fake BOS inducements. Okay, this is how the market is moving. Yes, we have fake BOS inducement, fake BOS inducement, fake BOS inducement, continuation, fake BOS inducement and continuation, fake BOS inducement continuation, fake BOS inducement continuation. That's all you see. Fake BOS inducement continuation, Fake BOS inducement continuation. The way I usually mark my structure is based on the color of the candle. Like on this particular time frame here, I can mark like this, but I'll just mark straight to the downside. Because when I look at this color, whatever color it is, yeah, when I look at this color, on this particular time frame, I'll ask myself, does it show me the exchange in this color of the candle on the lower time frame? On the lower time frame, yes, it may possibly show me. It may shows, but I only mark that only which I can see on this particular time frame. So you mark that only which you can see on that particular time frame. If you need more information, you go to lower time frame, or you go to the other time frame, which is clearer. So if I'm marking, I can mark this higher high, higher low, higher high, higher high, higher low, low, high, 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 low, high. You can see how I'm marking my structure. If I say this is from this, if we say this is still on the internal and external structure. So I have this push upward. This push is an upward push. I have this push to the upside. From the low to this high, the low to this high, the internal structure is going to be anything between this high and this low. So this is external. The black is my external. The external structure. Let us not forget this blue that I draw here is this black external structure. See, has this internal structure in it. So the blue represents the internal structure, while the black represents the external structure. So what people expect from this high to this low. So this is our external, the black. Then we have this blue internal to it. So what people expect is this. It should be black. This Dix. So what people expect is this. Then they say you have internal structure. And when price finally takes the high, they say we have external structure. This is the explanation. I want to believe everyone knows this already. Yeah. They say this external structure. And when market take this high, we have external structure. Yeah. We already understand this. Now, where the confusion comes in is when you have your black, this external structure, your external structure you have, it's supposed to be This black, which is supposed to be your standard structure, does this. So let's assume the black is let's assume the black is our 5 minutes. The black, which is the external structure, is our 5 minutes, and the green is 1 minute. Does that still makes all this an external or internal to this? Does that still make this, all this that is inside this external, does that still make this external or internal? Remember, you still have your 1 minute looking like this. Inside here. So if you follow your trading plan and you see liquidity grab on 5 minutes, for example, you could never catch a trade between here, between this place, from this side and here. You will never be able to catch a trade. You will still be waiting for liquidity to be grabbed under here. To come and be grabbed under here. You'll be waiting for it to go outside the range before you can catch any trade. So what you need to understand is it is still 5 minutes. It is still 5 minute structure. The one sitting inside the external, this external. External, they are referred to 5 minutes. So this one inside this external is what we refer to as 5 minute substructure. Substructure. So the substructure is currently, let's say the substructure is making you understand that this structural point belongs to this time frame. However, it is sitting internally. So if I'm to pick a trade based on a substructure, I can sell from here. And I can buy from here. This is fake BOS inducement. There are chances that I would have seen a good trade here to sell, and I would have seen a good trade here to buy. So I'll be picking my trade based on this substructure. Although I still need to follow the rules, looking for the liquidity grab. That is looking at my 1 minute before I pick any trade or pick the trade. Just hope this is not too complicated, but we are getting there. See, the internal, which is 1 minute here, is less important than the substructure, than this substructure. Until price take this high, it is less significant. Okay. So we have this. We have this from this move to this high. From this high to this low. Everything here is a substructure. So the best place you can see your trade is from this area, these substructures. That is the best place you can see your trade. When you have this substructure, this is a external structure. From this high to this high, this low to this high is an external structure. Everything that is happening inside here, this is a substructure. This is a substructure. This is a substructure. The best place you can see a very good trade is from this substructure. And how do we do that? By going lower time frame. Okay. Are you getting me, guys? Hello, guys. Are you there?
Yes, we're here.
Okay. So we'll be having 2 sessions for this external and internal structure. We're going to be having 2 sections. We'll likely continue the session with the other stuff we have in our content for tomorrow. Okay, so that will be all for today, class. Yeah, thank you, guys.